Nilesh Shah from Axis Direct joins in on the show. Nilesh, hi, good morning. Always good to have you on the show. Entering an extremely crucial fortnight by way of trigger points for the market, what do we expect in the next 15 days? Volatility or a lackluster market?
I think I will vote for volatility. There are crucial events which are coming up over the next 15 days. Starting today, the election results which will determine how the reform process will shape up over the next 2 years, and then rounding up with budget on 16th of March, which will determine how investors will look at India. Between these two events, we have some of the macroeconomic situation either turning good or bad in terms of liquidity, in terms of interest rate, in terms of currency. So we'll have fair amount of volatility as we move forward over the next 15 days due to unfolding of events across this arena.
So, Nilesh, after 15 days, do you expect markets to trade higher or lower?
It all depends upon what we do in this 15 days. Let's look at a positive scenario where the election results in UP and other 4 states results into mandate for carrying forward reform process. We move forward with some petrol price hike which helps us in reducing fiscal deficit. The budget comes out with innovative ways of raising revenue and at the same time releasing liquidity for turning around the capex cycle, and the fiscal deficit comes on a firm trend on the way down. The RBI releases liquidity through CRR cut and probably brings down rates, and this whole thing creates a momentum, one on the reform side and second on the growth side. And hopefully oil prices, which are building up some war premium, also starts nudging down. And this whole combination creates a positive momentum for the market. On the other hand, the whole thing can turn around if we see the UP election in other 4 states resulting into a mandate which is not reform oriented. The budget disappoints investors on the fiscal deficit side. The liquidity tightness continues, the interest rate hardness continues, and then the momentum for growth kind of starts slowing down. Investors will be disappointed and markets will be lower 15 days down the line than what it is today. So what happens over the next 15 days will determine where the level of index will be after 15 days.
Right. Nilesh, one very basic building block of this year's price action has been the assumption that interest rates in India have peaked out, and if not in this credit policy, by next credit policy, Reserve Bank of India will start cutting rates. But given the way how crude prices and commodity prices have moved, crude is at a 9-month high, copper prices are at a 3-month high. Do you think it will be impossible for Reserve Bank of India to oblige?
I think we have to look at things in a different perspective. Crude at $125 and currency at 49 or 50 to a dollar is almost implying in the original price when crude was at 125 or 130 and rupee was 44. Now crude in some sense is at $150 in a rupee adjusted terms. So the pain which the fiscal deficit will have to bear for current crude prices at $125 and rupee at 50 is far more than when it was at 44 to a dollar. Second, the growth momentum is weakening as witnessed by the third quarter GDP data. Part of this is also coming because of higher crude prices, tight liquidity and higher interest rate. Now maybe interest rates can't be cut, but can the liquidity situation be resolved? I think if liquidity starts coming back into the system, then probably economy can withstand a slightly higher interest rates for a quarter, and then depending upon how inflation moves and interest rates direction, economy can recover. So it's a fairly tricky situation, and probably we believe RBI will be focusing first on liquidity and then on interest rate and giving equal weightage to inflation as well as growth. I think market will be happy to give that space to RBI where liquidity is eased off first and then interest rate starts coming down.
Nilesh, I want to revisit that rate sensitive trade, because if you do a dipstick and a survey, just about everyone on the street is bullish on rate sensitive stocks, and the assumption is the obvious assumption which we've discussed, that Reserve Bank of India will cut rates. Do you think that rate sensitive trade is getting crowded?
Again, it's a slightly difficult call to take, because while one can have difference of opinion as to when RBI will cut the rates, there can't be any difference of opinion whether RBI will cut the rates or not. So from that point of view, an investor who is into the rate sensitive sector can afford to take short-term pain and still hold on to their position. But from a trading point of view, certainly probably since the consensus is built on the fact that rates are going to cut in the near future, and if there is a disappointment on that side, probably there could be some amount of correction. But that will be part of a larger correction rather than standalone correction. And again, rates will be function of one, the policy rate itself, and second will be function of liquidity. March has been traditionally very tight month. We have seen short-term interest rates going up to almost yearly high level. Now, if somehow liquidity can be brought back into the system, then probably even if policy rates are not cut, rate-sensitive sector can still get some support.
So Nilesh, how do you think the RBI is going to approach the topic of liquidity? Because clearly that is something that the markets want. Rate cut or not, they want to know how the RBI is going to bring in fresh liquidity into the system.
I mean, clearly they are firing on all guns to manage liquidity. They have cut CRR. They have conducted open market operations. But all these things is not resulting into tight liquidity situation which is persisting almost since May 2010 till now, and probably the borrowing by banks from the RBI window is almost at all-time high level. Probably some amount of liquidity is stuck with the government in terms of WMA surplus. Hopefully as the spending gets conducted over next month, it will come back into the system. But that's a very, very small percentage of overall tightness. Probably currency market explains some amount of liquidity which is tightened in India. There has been record amount of flows by FIIs both in equity and debt market in first 2 months, and in spite of that the foreign exchange reserves have remained virtually at the same level. In some sense probably it looks like importers have prepaid their obligations and exporters have not brought back their receivables into the country, resulting into probably some more amount of outflows from the local system by way of dollar purchase, and that partially could explain this tight liquidity. If that money starts coming back into the system, hopefully we will see liquidity situation easing off, but we will be looking forward to RBI conducting open market operations and CRR cut to kind of bring liquidity back into the system.
In December 2011, Nilesh Shah was a bull, and I remember this conversation where you made a case that our viewers, they should allocate money to equities. Now that markets have appreciated by about 15% plus, individual stocks have appreciated by about 20 to 25% plus, is it time to exercise caution?
I think over next 15 days, definitely one has to exercise caution. A lot of events are unfolding which are binary in nature. They can either pull the market up or they can pull the market down. And it's very difficult to predict how those events will be. So if people who have invested in December 11 and they are sitting on huge amount of profit by virtue of certain stock appreciation, then probably it's time to take some amount of profit. But if you are a long-term investor and you can withstand this next 15 days volatility, then probably you should continue. One thing which all investors should do is to buy on correction rather than buy on rally in next 15 days.
Okay.
No matter what the good news will be, since there's so much of news coming in, probably it's worth buying at the time of correction.
Nilesh, what is the worst case scenario? What if the outcome of UP election or credit policy or union budget is not in a desired manner or is not in a way what markets are betting on? So what is the worst case scenario if these three events which I mentioned, they do not play as per script?
On top of these three events, if there is something related to crude which results into flare-up of prices because of the geopolitical tension, that's kind of a scenario which can bring market down quite significantly from current level, probably where the entire rally began. Valuations are still supportive of the market, but they are not cheap as they were in December 11. If markets were at December 11 valuation, then all these four events going wrong also would not have brought market down. But because we are about 15 to 20% up from December 11 valuation, and there is expectations from the market in terms of positive political outcome, a reasonably good budget, non-flare-up of oil prices, and also RBI managing liquidity and interest rates, if all this four even goes against the expectations of the market, then certainly there will be correction in the market.
So Nilesh, what is the expectation from the budget this time around? I mean, can we expect certain sector moving moves coming in or commentary coming in from the government, or do you think it is going to turn out into a non-event as was the case last year?
No, I don't think so. This time budget can be a non-event. There is a fair amount of expectations from investors. The first expectation is to manage the fiscal deficit. Globally, we have seen how higher fiscal deficit countries have been derated. Countries like Greece are down about 86% from their, on a one-year basis because their deficits have run up very, very high. So clearly, India is not comparable like Greece, but there will be focus on fiscal deficit. And compared to 4.6 this year, the actual number could be anywhere between 5.5 to 6%. So certainly people would like a direction from this budget whereby deficit is coming down. That's directly going to impact the valuation of the market. The second thing is related to revival of private capex. We have seen our savings rate drop over the last couple of years because of fiscal deficit being high and because public sector organizations have not saved as much as they had saved earlier, and this is resulting into private capex coming down. There is also partial crowding out effect by virtue of government's borrowing program. So in this budget, people will be looking forward to ways and means by which private capex could be revived, which will be guaranteed for the growth going forward. The third thing will be related to administrative measures, which might be related to various sectors. So there is a fair amount of expectations from the budget to kickstart the growth and correct the fiscal situation.
Nilesh, the bulls are of the view that for Indian markets, yes, we may twist, we may turn, things may remain volatile in the near term, but the new bull market has started and we are unlikely to go back to December lows of 44 or 4500 on the Nifty. Do you buy that argument?
I mean, generally I will tend to agree with that argument, saying that in spite of any volatility, the longer term outlook for India is very, very good. On the global side, US has started recovering. Their fourth quarter GDP number has come quite positive at 3% level. In Europe, people have bought time. A 1 trillion euro plus kind of liquidity enhancement measures will eventually create risk on trade. So globally things are reasonably setting in place, and we probably are going to see an improving macro in terms of falling inflation, increasing liquidity, lower interest rates, and probably stable currency as we move forward. However, I would not like to agree with this fact that we can't go back to December 11 valuation. I mean, that possibility always remains open if all the events over next 15 to 20 days are going against the expectations of the market. Now, probability of that happening is very, very small, but as an investor, you should be aware that if this event happens against the expectations of the market, then there could be downside. But certainly I will agree with the statement that on a longer term basis, this correction will provide a great opportunity to invest.
So what is the best way to make money in an environment where central bankers are printing money, Operation Twist has started or still on, LTRO2 is going to be about 600 billion pounds. What's the best way to make money when global money is cheap?
I think the first thing which we have to remember is that almost 35% of global liquidity is lying in kind of savings account or current account kind of non-yielding instruments. Across the world, interest rates have come down, whereas the inflation is still running high. So at some point of time, this huge amount of liquidity will start moving towards higher yielding assets. It could be resources, it could be emerging market equities. So don't keep your money in cash. Try to put it into a use right from high yielding short-term instruments in Indian market all the way up to equities. The second thing is in terms of sector allocation, try to be positioned for those sectors which are likely to be benefiting from this increase in liquidity. Resources is clearly one sector where we think probably prices have bottomed out, values are below their fair value, and due to concern on global growth, they are available at a discount to their fair value. The second thing could be small cap related sectors where the valuation discount vis-a-vis large cap is running at almost all-time high level. Certainly, small cap is a risky bet, but a certain percentage of portfolio can be devoted to this sector because it has potential to outperform or give outperformance on the way up. So you can divide your portfolios, put your cash to work rather than remain idle, and then buy on the correction in next 15 days when the volatility will be probably highest.
Why? Because you've given us a reason why traders and investors should be buy on every decline. So what should they buy?
In terms of sector allocation, I think resources provide good opportunity today. Telecom and pharma provides the defensive edge, and small caps. So these are the four sectors where one can put a risk on trade with a view to get outperformance over next 1 year.
Anything specific?
Nikunj, I'll not make stock specific comments, but any company which is not heavily geared will be a better bet in today's environment.